thanks for joining us again for our regular investment update. Markets, obviously, with the banking sector and the concerns that we've faced over the last few months, has seen some volatility, but we've seen a pretty strong March quarter from a super fund. Is the worst behind us, and can we expect to finish the year on a high?
Well, I'd love to finish the year on a high, but I'm not sure the worst is behind us. So with interest rate rises, there's typically a lag of 12 to 18 months before their full effects are felt. So when you look at rate rises around the world, in Australia we've had another rate rise today. The US, which has been consistently raising rates and will probably do so again on Thursday, and in the European Union, rates have been rising, and so we'd expect to see more impact from that over the year ahead.
And so, Michael, very sort of similar question. Until the end of March for the financial year, members investing their superannuation have 13 investment options within the fund. All of those are positive financial year to date, highlighted by our balanced growth option, which is sitting at 7.76%. Can members expect to see positive returns after negative returns last year, or very similar to what you just said?
Look, it's only a couple of months now until the end of the financial year, so it's very, very difficult to say what might happen over that period. Last week we saw the First Republic Bank get in a real trouble. Now it's been taken over by JP Morgan. Those things can happen and change things on a dime, turn things on a dime, as the Americans would say. Or we could just keep going as we have been and see a bit more accumulation in returns through to the end of the year. Very difficult to pick over that sort of time frame.
Yeah, so still some uncertainty.
Very much.
One of the things I also wanted to talk to you about today, we've been doing a bit of work from an ESG policy perspective, and we've made some changes there and how we manage our carbon exposure. That information will be available to members on our website as of the 1st of July. But can you just talk to us a little bit about why we've made those changes?
Certainly. So the reason we've made those changes, there's a number of reasons why we've made the changes. First, government regulation, Your Future, Your Super. We have benchmarks we need to beat over 8 to 10 years. Now that may sound like a long time, but some periods of poor performance can easily change the circumstances there. Right now we look pretty good, but if we're cutting out parts of the market, that can really turn on you, and particularly in the resources sector and energy sector. So what we've done is cut back on our exclusions, not all of our exclusions, but some of our exclusions, particularly in the carbon area. Now another reason behind that is it's not actually clear which companies are most impacted by the energy transition. And for example, airports, which have very little carbon emissions, yet they're very dependent on aeroplanes coming and going, airlines, and they're extremely carbon intensive. So you could see issues there. But, when you do exclusions, you don't exclude airports. They're very low emitting in their own right. And there's lots of examples like that. It's not just about supply, it's about demand, it's about customers. And it's also about effective action. So if you leave a company, you have no impact on it, really. They don't really care what you say. If you have an investment with them, then you have the ability to put up shareholder resolutions, which we do and have done. You can make statements, which we have done, and you can try and have an impact that way, because when you sell your shares, when you leave, someone else buys those shares. Now, just because you own them doesn't mean you're going to do something, but I think our record shows that we do try and get change, and our perspective is exclusions, divesting from a company really doesn't. Maybe it makes people feel good. Does it actually change things? It does not appear to.
And I know we've spoken about this, but an example of that is AGL and Mike Cannon-Brookes. If you talk a little bit about what happened.
Well, that company had been a leader in transitioning away from fossil fuels during the Abbott government era. They reversed that move and became by some measures, the largest emitter in Australia. They really didn't look like they had a strategy. We weren't invested in it, so members weren't hurt by their big fall in share price. But Mike Cannon-Brookes, he didn't divest. He actually invested quite a lot of money, and now he's turning that company around, him and other shareholders and the board, and getting on board with the energy transition. Now that's a lot better place to be, broadly, than would be the case if they said, oh, no, we shouldn't hold that, it's a bad company.
Thanks, Michael. So those updates about our ESG policy and the other matters affecting that will be available on our website as of the 1st of July. So please, if that's of interest to you, take a look. For those that are joining us again for an investment update, thank you very much. Keep an eye out for the next, and we'll speak to you soon.